Okay. Well, we're gonna start things off. We're gonna try to respect everybody's time. Appreciate everybody coming in, joining us tonight for a presentation by Parvis on tax efficiency of private capital, private projects. Just before we start off, just wanted to give you a little background about who Parvis is. The company started off in 2022. The whole objective of the owner and founder was to offer a platform, an online platform, to give access to the retail investor the opportunity to invest in private equity, private capital. Our platform is ongoing and evolving, and it allows you to basically do everything from A to Z online in a very encrypted and secured environment. The platform keeps you up to date on the different projects that are coming, some of the different funds and issuers that we're approving. So it's an ongoing moving target. And again, we wanted to thank you tonight for joining us. Just wanted to get through some housekeeping issues here. We have a disclaimer: the content is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. Nothing in any presentation shall be construed as a recommendation or offer to sell or solicitation of an offer to buy any securities. We always recommend before you do invest that you do check it out with your accountant or your tax specialist just to see if it makes sense and it fits into your portfolio model and your tax efficiency for you. Tonight, we're joined by two of our issuers on our platform, Mr. Jamie Vilas from Secure Capital and Mr. Darren Gadag from Pier 4 REITs. These are two private issuers that we've had on the platform, and they're going to give you a little bit of a background of what they're all about and some of the tax efficiency options that they can offer. So we're going to start things off with Jamie Vilas. Jamie, take it away.
Thanks, Robert and Sarah, for setting this up. Good evening, everybody. I think I have about 15 minutes to present our company. It's about one glass of wine, so we'll try and get through it, and Sarah's going to help me move the slides along. Secure Capital, Mick, what we are is to keep it simple, is a fund of residential mortgages that we manage across Ontario. We have just under 700 mortgages and just over 600 investors. So we'll talk a little bit about what the opportunity is in investing with our company. We started the company 19 years ago, started with a very small amount, just under $10 million, and we've grown substantially since then, and we're in that sort of 70 to 75 million at this point. And again, it's strictly residential mortgages that we manage, so single detached homes, condos across Ontario. We like major city centers predominantly, so we're not doing a lot of the rural stuff. It's just very hard to exit out of those homes or properties if there's a default. So we stick to the major centers. Sarah, if you wouldn't mind going to the next slide. This is just the disclaimers, of course, that what we've done in the past 19 years doesn't necessarily reflect what we're going to do in the future. You can go to the next one, Sarah. Similar legal jargon that we can pass because we don't have much time tonight. We'll go to the next one. Again, go back to the next one. Sorry, Sarah. We started in 2007 and been funding first and second mortgages since our inception. We started with first mortgages predominantly, but we've expanded that, and we're actually do more seconds than we do first at this point, just because there's a lot of competition in first mortgages only, and the margins are low in first mortgages. So we've, in order to consistently produce a dividend of 8%, which we've been doing for 19 years straight, you need to do seconds as well to have that margin consistently. It states that we lend in Quebec as well. Really, we lend in Montreal, not much more than Montreal. Myself and one of the other original partners are from Montreal. So we know the market very well, but it's a very small part of our portfolio. Only 5% of our portfolio is actually in Quebec. We focus on short-term mortgages that help people with life events, separation, job loss, death in the family, any life event you can imagine. We've seen it, and we provide a mortgage that customizes their situation, but it's short term. Like I say, 6 to 12 months, just to get them through whatever life event they've had. Our biggest calling card in our company is we've never missed a dividend payment. It's been 19 years now. So, we pay at 8%, and we pay monthly. So our investors love that. We've made a lot of investors very happy over the period of time. Management is heavily invested in our company. So management and employees, actually. We own about 15% of the company as far as the investment units. So we're heavily invested. So that means we're going to look after your money the same way we look after ours. Okay. And just to reiterate, because we don't have a lot of time, this is real estate, mortgages, single detached homes, and condos. We don't do commercial. We don't do land development. We don't do any sort of difficult or complex lending. 99% of our deals or mortgages come from the mortgage broker community. So we keep it simple. We fund about 20% of the applications we see. So we have a big vetting process to make sure that we're, cherry picking the best deals. Mission statement is very simple. We're looking to provide a stable income to our investors, which we've done for 19 years, and we're looking to preserve capital. Okay, so we're not sexy, but we're steady. That's our motto, really. We can go to the next one, Sarah. Just management. Unfortunately, I'm the old guy now. I was the young guy when we started. My two original founders, the father of Sherry Kostrick and the father of Sasha Singal, are now retired, enjoying life in Florida. And the three of us, about 12 employees, are running the company for the last 10 years. Sherry has been with the company since day one, is now the CEO. She started off as an underwriter. Sasha started about 15 years ago, and he's now in enforcement and renewals. We'll go to the next. Sorry. There we go. I won't spend too much time in this, but this is where Michael and Robert can really help you explain how the tax efficiency works for your investment. But basically, to keep it simple again, it's a tax flow-through structure that allows the revenue to flow through our company without tax. It just allows us to provide that consistent dividend to our investors. We'll go to the next one, Sarah. Has everybody through their first glass of wine yet? Not yet? Okay. All right. So if you're leaving your investment in with us and you're not getting a monthly dividend, and we call it dripping or compounding, then of course your yield is going to be a little higher every year. It's going to be 8.3% just because of the compound effect. So, and again, this has been 19 years in a row. So it's a solid investment. Again, we're not there to shoot the lights out. We just like to keep it steady. And it's very simple. You're basically investing in solid real estate. And people are very attached to their homes. They don't let their homes go easily. If they miss a payment, they're right on the phone with us. They make sure that they can find a way to make the payment, even if it's late. So people are attached to their houses and their condos because that's where they live, and they usually have kids and they don't want to move and so on. So we're heavily regulated in this industry by the CRA and the OSC, and we spend half our days with paperwork being So it's a very, very regulated, even though it's a private company, we're extremely regulated. Audited statements we provide to Parvis, along with a few other exempt market dealers that we deal with every year, and that time is coming up pretty soon. We actually have to have it into Parvis by May, so every May they have our annual statements that they can share with you. Okay, we'll go to the next one. So what's the investment opportunity, or who are the individuals that are, just over 600 investors, that why would they invest with somebody like us? I mean, the main reason is investors are looking for income, right? So they may be, in a certain stage of their life, not working perhaps, and they need to complement or supplement their income. So, for example, $100,000 at 8% gives you $8,000 divided by 12. It's a supplement to your income. So we have those types of investors. We also have a percentage of investors who are looking to just grow their investment and if in a TFSA or an RSP, and grow it through compounding and not touch it for X amount of time so that investment grows. And, $50,000 over a period of time can grow quite nicely if you don't touch it, and it's compounding at 8%. We provide quarterly statements so you can see it. We also have a portal so you can see your investment on a daily basis if that's what you want to do. So it's good that way. We talked about the registered accounts. It's RSP eligible. It's TFSA eligible. So you have the opportunity to grow your investments tax-free or tax-deferred in the case of the RSP. It's also a portfolio diversifier. So if you have some investments in the stock market or wherever else, this is a nice way to invest in real estate without having to own a second house and become a landlord and so on and so forth. This is a nice way to have passive income without too much complication. Okay, we're very experienced managers. Between the founders, myself, and the two partners that I have, plus our employees, we have many, many years of experience and literally thousands and thousands of mortgage applications that we've seen and funded. Okay. Yeah, we can go to the next one. This is what we were talking about, the compounded effect. So as you can see, if you put it, as an example, $100,000 in, within 7-8 years, you're going to have doubled your money if you leave it in and you let it compound. So it's a nice way to grow your money without complications. It's a very, very simple way and easy to understand investment. Okay, we'll move to the next one as well. Mission, I think we've talked a little bit about this already. So it's a predictable and consistent dividend, 19 years straight, month over month over month. And that's huge, right? A lot of people don't want the ups and downs of the stock market. They want something that's consistent, reliable, certain. When you get to a certain stage of your life, especially if you're self-employed, the last thing you need is more risk. And if you worked hard for your money, you want that money to be looked after and not have to think about it. How we do it, there's a number of factors, too many to list here, but a few of them are the fact that we do short-term mortgages. So when the market changes, we can adjust our underwriting. Disciplined underwriting just means making sure you have a proper grid that you're looking at when you're reviewing a mortgage application from the mortgage broker community. Does it make sense? Even though, it's not going to be a perfect mortgage application, or they just go to a bank, they came to us for a reason. Does it make sense to lend this individual or family money? And how are we going to get the money back? There's got to be an exit strategy, and there's got to be a use of proceeds that makes sense. Okay, geographic diversification. That's why we say that is that we don't have all of our money in the GTA. Okay, it's spread out over major centers across Ontario. So that can be London, that can be Oshawa, that can be Sarnia, that can be Guelph, and so on and so forth. So that's one thing we do. And we look at the different trends at different cities across Ontario as well. You know, the car industry in Oshawa and Windsor, you got to watch that and so on. Minimal loan concentration, that just means we don't put, $3 million into one mortgage. Because if that goes bad, that's a big percentage of your portfolio in one loan. Our average loan is $150,000. Okay, so small loans, short term. Okay, focus on urban centers. We talked about that, and we have a massive broker community that provides us the mortgage applications because we've been around for a long time. We'll go to the next one, Sarah. Okay, so this is a little outdated. I do apologize about that. I have to talk to my marketing department there. It's a little outdated. But anyways, we're just over 70 million. Average size is about 150,000. Our loan to value average is under 70%, which means that, when you're lending on $1 million home, for example, in the GTA, you're not going past 700,000 on average. Okay, so there's room there. There's a buffer there in case the market goes down. You're protected. Does it always work? Do we ever have losses? Yes, we do. If you're in the mortgage business, especially doing first and seconds, you're going to have losses once in a while, but we know how to manage that. And we have an interest reserve in our fund where we hold back 1.6% of our fund to make sure to cover any losses that we may have in that year. Losses do happen. It's part of the mortgage business. Even the banks have losses, so it's part of the game. As you can see, we're heavily concentrated in Ontario, of course, and heavily concentrated in the 50% is in GTA, 44 in Ontario, and as you can see, it's a small percentage in Quebec. We'll go to the next one. Products, I think we've talked about this, first and second mortgages. We do construction mortgages, which mean, however, the construction mortgages we do, the client has to be 60% complete before we jump in. So we're not doing it from the ground up. It's really 60% complete, and then we'll give them whatever money they need. On average, it's about $500,000 to finish off the home. What happens is a lot of general contractors and clients miscalculate how much money they need to build a home. That's usually when we're stepping in. Renovation financing, we do a ton of that. And again, we've talked about the terms. Our borrowers, obviously they have to be homeowners. There are a lot of self-employed individuals that can't get financing at the bank. There's individuals that don't want to break their first mortgage, and they have 50, 100,000 of credit card debt that they want to pay off. Our rates range anywhere from 7 to 12%. So we're better than credit cards, of course, and we consolidate into one loan rather than having multiple payments. And of course, it's individuals who don't fit the criteria of credit and or high total debt service. How are we doing on time, Robert?
We're good.
Yeah. We're good. Okay. We'll go to the next one there, Sarah. Underwriting, what do we look at when we see a mortgage application, and how is your money protected? When you invest with us, strong management, right? Strong underwriting. We're looking at a few things, right? We look at the collateral, so of the property we're lending on, which is of course the house or the condo, and those appraisals are done by a third-party appraiser, and we have a list of appraisers we use that we feel comfortable with. And we also get a real estate opinion to make sure that the appraiser's doing their job. And that's the first thing we look at, okay, is pride of ownership and so on, right? So, we want to make sure that what we're lending on is not a hoarder's home or something like that. Capacity to borrow, well, they have to be able to afford a mortgage when it's at a higher interest rate. But we're not as strict, of course, as the typical banks are. Otherwise, we would never lend any money. we're much more flexible than the banks are. And in the case of a client who's lost their job, how do they pay? Well, they can't. But we know they're going to find a job if they're at a certain stage in their life. So sometimes we prepay mortgages. Okay. What that means is they're borrowing the payments for 12 months or 6 months from us. So they're borrowing a little more than they need to consolidate their debt. Plus, we give them the 12 months payments in advance, deducted so that they don't have to make the payments. And that's called a life event. And we get them to stage 2 through the mortgage broker community, where they take us out in 6 months, 12 months when they find another job. Capital sufficiency, what that basically just means is the loan to value, right? We're not going to, if they own $1 million house, we're not going to 900,000, right? There's got to be, we like to be in on average 70% of the value of the home. Character, how long have they been in the home? How long have they been in the job? And that's important as well. And obviously there's exceptions that are made if they've lost their job. That's a life event. Credit, we're not looking for perfect credit. We're looking for a reason why they got into trouble and why their score is low. Again, if every client came to us had perfect credit, then what do they need us for, right? Then they just could walk into their own bank. So, we're what they call an alternative lender. And there's a huge need for that, right? Not everybody fits into the bank's guidelines, right? If you're self-employed, try and go and get a mortgage, right? If your home's worth more than $600,000 or $700,000 and your mortgage is X amount of dollars, not that easy to get a mortgage if you're self-employed. Believe me, I know I'm self-employed, so it's not that easy. We'll go to the next one, Sarah. Okay, so this is really what the product offering is. So the minimum is $5,000. We're able to go up to 85 million in capital raising, and then obviously we can change the offering at any time. But for now, it suits our needs, and it's $1 per unit. So if you, as an example, bought $5,000 worth, you have 5,000 units. It's an 8% return month over month, and 8.3% if it's compounded. A lot of people ask me, what's the redemption period, or how do I get my money out? Very simple. 60 days notice, and you'll have your money. We have never missed a redemption in 19 years. So we have a lot of capital coming in and out because we have short-term mortgages. So we have a lot of cash flow coming in every month. So we have never missed a redemption period request in 19 years. So that's really not an issue if that is a concern for you. I think we're done there, Robert.
Super. So we'll wait for questions at the end
Sure.
of the meet. We want to get Darren in here with Pier 4 REITs. So Darren, take it away.
Great. Thank you so much. Really appreciate it. I'll move quickly, be really concise, save plenty of time for Q&A at the end. So really just to set the stage, we are a multifamily REIT. Next slide. Always the most exciting part of any presentation, but certainly please take a moment to review our disclaimer. This document is not a formal offering document. Prospective purchases will be provided a formal offering memorandum and certainly must be qualified for investment prior to making any investment. Next slide. I will move very quickly. So this presentation is really broken down into 5 parts: market environment, the fund, the strategy, the portfolio, and then certainly the offering details. How can you participate? Next slide. So Canada's rental market is still historically tight. Purpose-built rentals have a vacancy rate of 2.2%. This is well below the 34-year national average of 3.1%. This isn't a soft market. It's a chronically undersupplied one. A vacancy rate this low is structural, and it certainly keeps pressure on renters nationwide. Next slide. Housing starts. So Canada needs roughly 3.1 million new homes by 2030. Simple math, 426,000 units per year. Yet, we haven't built anything close to that in decades. Meanwhile, Canada brings in nearly 10 times more people through immigration than it loses through immigration. One new immigrant arrives every minute, one person leaves every 11. Demand hasn't disappeared, it's just paused. And when it returns, the supply gap will only amplify upward pressure on rents. Next slide. So CMHC data really confirms our core thesis. Pier 4's target class really is in the highest demand. Vacancy rates are slightly higher in new, more expensive buildings, those built 2000 and onwards, and lowest in affordable established assets built between 1960 and 1999, the exact vintage that Pier 4 targets. So across all provinces, these mature assets consistently deliver lower vacancy, stronger affordability, more stable cash flow, and insulation from luxury oversupply in urban cores. So this table and chart both reinforces the same insight. Renters prefer well-located, affordable, established rental stock. And Pier 4's strategy is directly aligned with this demand. Next slide. So cities where Pier 4 is active really are at the forefront of national rental growth. So from 2021 through 2024, Moncton saw rates rise 31%. Halifax followed closely at 30%. Kitchener-Waterloo at 27%. These are not speculative markets. They are high demand, low supply centers with stable employment and strong fundamentals. So Pier 4 focuses on markets with sustained population growth, persistent rental demand, and low vacancy rates. In cities like Moncton, Halifax, Kitchener, Waterloo, demand consistently outpaces supply, creating really the ideal environment for income stability and long-term growth. So by being active in these markets, Pier 4 is positioned to take full advantage of these strong rental trends. Next slide. Moving on to the fund. Next slide. So just a snapshot. This is as of December 31st last year. So we have a weighted average appraised cap rate of 4.5%, 41 buildings. The asterisk denotes buildings under contract. Once those buildings close, which they will by the end of Q2, the portfolio will consist of 2,041 total units. Occupancy is strong at just shy of 97%. Historically, we have paid an 8% targeted distribution, compounded annually, paid monthly, and historically been 100% return of capital. So extremely tax efficient. Our NAV, or net asset value, today is $11.35. We have a targeted return strategy of 12 to 15%, which is a combination of the distribution and the capital appreciation of the underlying assets, in our case, the apartment buildings. And we've certainly internalized property management as well as capital improvements. Next slide. So just to draw your attention from left to right, inception for Pier 4 was Q2 2020. We closed out 2020 with an AUM of 6.7 million, 4 properties, 73 units. Fast forward to the middle of the page, 2023, we crossed $100 million in AUM, 18 properties, 493 units, and we had our second NAV increase. We started at 10 and we went from $10.30 to $10.55. Moving over to the right, in terms of Q1, current AUM is a little bit north of 411 million, 40 plus properties, and expectation as we close out Q2, we will be north of 425 million, 41 plus properties, over 2,000 units across the entire portfolio. I think certainly by any measure, any metric, over the last 5.5 years, Pier 4 has certainly delivered strong growth. Next slide. In terms of investment growth since inception, as you can see, steady, consistent, dare I say, predictable performance. On the far right, just a snapshot of returns per DRIP and cash, and Class A cash. Since inception, annual compounded returns has just been shy of 60%. Next slide. So who's behind Pier 4? So as mentioned, we are a family-run multi-family REIT, really leveraging over 40 years of experience in property ownership, management, and value-add improvements. So the Ashby family, prior to founding Pier 4, ran a very successful renovation company dating back to 1981, where they really did serve some of major Canadian landlords and eventually expanding into building their own portfolio in the early 2000s. So leveraging this track record as experienced owner-operators, the family created Pier 4 really to give investors an opportunity to invest alongside them. Today, Pier 4 operates out of 3 offices. Our downtown headquarters is on York and Wellington. We have an office in Cambridge, Ontario, which serves as a property hub for our southwestern properties. We have an office in Moncton, which serves as a property hub for our Atlantic Canada properties. We have over 94 employees. We're growing across every single department. We are a comprehensive asset and property management service company. Collectively, we have well over 100 years of combined industry experience, and something that we are very proud of, a network of over 3,000 trusted investors. Certainly along the way, we've been able to accumulate a couple of accolades. Last year was the second year in a row that Pier 4 was recognized as one of Canada's fastest growing companies. Next slide. So corporate governance is absolutely crucial to our success. We do select industry professionals to oversee the fund's management and affairs. These independent members really do provide strong oversight to our standards, policies, strategies, budgets, property targets. And it goes without saying that certainly our stakeholders hold us to a very high standard to ensure no conflicts of interest. Next slide. Moving on to the strategy. So our philosophy is simple: deliver consistent investor returns, provide affordable, comfortable homes, offer full transparency, give investors the benefit of real estate investing without the work and headaches. Next slide. So in terms of our investment strategy at Pier 4, we are 1,000% committed to providing investors with a well-managed, diversified pool of multifamily assets. We are really focused in on acquiring value-add real estate across Canada, and most importantly, optimizing profitability across the entire portfolio. We want to maximize investor returns. So we follow a disciplined RRR approach. Realize, we acquire off-market, undermanaged assets with strong upside. Revitalize, we want to enhance the intrinsic value via renovations and operational improvements. And then certainly returns. Distribute monthly income, special distributions, and of course, long-term NAV growth. Pier 4 has had 6 NAV increases, and we're anticipating another one in very short order. To draw your attention to the right-hand side, our average historical renovation cost across the portfolio since inception is $15,000. Context: we have a 3-tier renovation approach. Bottom rung is bronze, something as simple as new fresh coat of paint, new curtains. Gold, which would be paint, curtains, new cabinetry. And then certainly platinum, which would cost anywhere from $23,000 to $25,000. As a result of that, we've been able to generate over $50 million in fair market value gained. I also want to share, as mentioned, since we control the process in-house, the team targets a 30-day turnaround. All renovations are executed when someone moves out, and a unit is available to be rented within 30 days. And lastly, an undeniable competitive advantage, our gap to market, the difference between in-place rents and market rents. Across the portfolio is 51%. So we are absolutely offering clients a substantial growth opportunity and without question, downside protection should rents soften. Next slide. Here's a value add. Excuse me, sorry. So this particular building is in Kitchener on Onward Avenue. We acquired this building March 15, 2023. Purchase price, $6.6 million. It's a 46 unit building. Strategic upgrades, we spent roughly $754,000. What did we do with that money? Well, in addition to turning over 16 units, we installed security cameras, corridor renovations, laundry room renovations. And as a result of that, we were able to raise rents from $920 to $1,295. Today, that market value for this building is $10.7 million, a value add of a little over $4 million in a couple of very short years. Key takeaway, targeted improvements drove significant rent growth and certainly an ROI of 62%. Next slide. So if you have your phone, I encourage you to grab it, scan the QR code. This is Pier 4 in action. So this particular example is a building in Kitchener on Tupper Crescent. We transformed underutilized storage lockers into 2 high-demand studio units. So this smart conversion certainly boosts rental income. It absolutely enhances overall property value, really maximizing both asset performance and, most importantly, long-term returns. Next slide. ESG. So certainly by reducing costs, we are increasing the potential returns for all of our investors. So all units benefit from Energy Star appliances, LED lighting, high efficiency boilers, water sense toilets. In addition, certainly from a corporate perspective, we do follow a robust corporate social responsibility program. We are actively supporting multiple charitable organizations. We run multiple initiatives focused on employee well-being, and we are always looking to actively foster community engagement. Strong returns, responsible practices, meaningful impact. Next slide. So moving on to the portfolio. So a key differentiator for us and really, really important to understand. At Pier 4, we strive to acquire low and mid-rise buildings in strategic growing markets outside of metropolitan areas, i.e. secondary markets. We are really investing in opportunities often overlooked by others. These are value add opportunities bought off market, buildings that haven't been run effectively or efficiently, really allowing us as professional property managers to unlock that intrinsic value. Our ideal size building is anywhere from 17 to 70 units. As you can see, brick exterior, concrete construction. Next slide. So really excited about these. These are some buildings currently under contract, with the exception of the London, Ontario one. We recently closed on this a week and a half ago. This is by far and away Pier 4's largest acquisition. Purchase price, $102 million. 558 total units across 9 buildings. That works out to be $184,000 per door. And best of all, it was appraised at 12% above purchase price. Right out of the gate, value creation of over $12 million. Another building we're closing on in the next couple of weeks is in Kitchener. This is a 97 unit building, purchase price 22 million in change, works out to be roughly $234,000 per door. And then at the end of Q2, closing in on a building in Peterborough, purchase price 13.5 million, 85 total units, works out to be $158,000 per door. And best of all, certainly appraised at 19% above purchase price. So an instant value creation of over $2.5 million. These 3 buildings are accretive to the portfolio, meaning one can expect a NAV increase in short order. Next slide. So in terms of a quick snapshot, portfolio summary, 41 properties, a couple of properties expected to close in short order, spread across 13 communities, 3 provinces. We have a growing footprint in Ontario, those quote unquote secondary markets. Sure, most are familiar with these. These are university towns, great infrastructure, fantastic connectivity. And then another key differentiator, a growing footprint in Atlantic Canada. And if you do remember some of the first slides, these really have been some of the fastest growing rental markets across Canada for over the last 5+ years. Next slide. So in terms of portfolio summary, just to draw your attention to the top left, again, Pier 4 opened its doors 2020, 73 units. Expectation at the end of Q2 will be over 2,000 doors. AUM growth, again, end of 2020, 6.7 million, and we will be north of 425 plus million at the end of Q2, and certainly growing. Again, a clear differentiator, a true competitive advantage, our gap to market, that difference between in-place rents and market rents across the portfolio is 51+%, offering exceptional potential for future growth and downside protection should rents soften. And then, of course, a breakdown, units by province, AUM by province, heavily weighted, at least at the moment, certainly in Ontario. I will add our pipeline is very deep. It's well over 720 million, 3,500 plus doors. So there is plenty of rental stock. As mentioned, we buy all our buildings off market, generally from mom and pop small partnerships who have in a lot of cases run these buildings or own these buildings for 20 plus years. They just haven't run them effectively or efficiently as a business should be run. Next slide. And then moving on to the offering details. So we have multiple classes available. Key takeaways here is that we pay an 8% distribution. Historically has been 100% return of capital, extremely tax efficient. We have never missed a distribution payment since inception. We have a targeted return of 12 to 15%. I am happy to share 2025 across all classes. We return anywhere from 12 to 14+%. So again, strong performance. We do have DRIP available, so 2% DRIP discount. Hold periods, when is money free and clear, ranges anywhere from 3 to 5 years. Class D and Class W, a bit of a key differentiator for us. These are our LP units. So they do provide certainly certain tax advantages. They continue to really resonate with both investors and advisors, due really to the combination of operational upside and tax efficiency. So as an investor, one can expect to receive anywhere from 3 to 5% capital loss flow through, which can certainly be used to offset capital gains. I believe that can be carried back up to 3 years or forward indefinitely. So this feature absolutely enhances after-tax returns, provides flexibility not typically available in traditional real estate investments. So ideal for business owners, and certainly best suited, or most suited, or only suited for, I should say, for open accounts. I'll conclude by saying, started February, concluding April 30th of this year, Pier 4 is running a promotional campaign. So any net new buys will benefit from 3% non-dilutive bonus units. Those units will be credited to your account on the close of each month. Bonus units that will be worth more with an anticipated NAV increase. Why? Those 3 buildings I shared with you are accretive to the portfolio. With that, I turn it over to you, Robert.
Darren, thank you very much. Jamie, thank you. Just to remind all the guests, if there's any questions, please put them in the chat. Michael Lechu, who is another advisor, will be responding to those questions. Also, to make sure everybody is putting their name in the chat to qualify for the draw for the wine at the end of the podcast. So we wanted to touch base, Darren touched base and Jamie touched base a little bit on the tax efficiency of these types of investments. What we want to just draw to your attention is the fact that, it's great to make 12% return on your investment. It's a question of how much you keep at the end of the day. So here we're just giving you an outline of two comparable investments: Investment A, which is a real estate trust, and Investment B, which would be like an interest bearing product. On Investment B, in a non-registered, so an open account, or we call it cash account, be it in corporations or be it personally. If you're making 12% on $100,000, that's $12,000, and all depending on your marginal tax rate, you can lose up to 50% of that, or 53% of it if you're at the top tax bracket. So it's good returns, but it's a question of what you're netting at the end of the year, and of course you have to pay taxes on that interest that's accrued, that's earned in that given year. If you look at a REIT, at $150,000 a return of capital, so there is no tax implication for you. Again, this is for a non-registered account, be it in a corporation or held individually. And there's a flow through tax deduction. So what that means is, and just take this down as a note, it's the T5013 tax slip. Your accountants would be aware of how that works and how that can offset some of the interest that you would be making in Investment B. You could apply that against that. Or if you're in a corporation and you make 12% on 100K, you can also expense it through your corporation and reduce the taxes you can pay at the end of the year on that too. So that's another option. The real estate trust, the long-term capital appreciation potential is there. We're not triggering taxes. We're allowing the investment to compound. And tax advantages can offset other income. Like I'd mentioned before, we can use the T5013 tax slip that's issued on the LP units. So for instance, to return to Pier 4 REITs situation, they have 2 classes, Class D and Class W. That would be very useful for somebody who wants to invest in non-registered money. If they've maxed out their TFSA, they've maxed out their RSPs, then that LP unit can be purchased through the corporation or through individually, and that can help offset some of that taxable income that you would incur at the end of the day. Sarah, you want to move along to the next slide? So here again, we're just comparing the two. When structured together, we're looking at those numbers. I'm not going to repeat them, but it ends up helping out. Keeping more money in your pocket at the end of the day, and making the non-registered option a little more interesting for you. Both funds that Pier 4 and Secure Capital offer the option to put in an RSP, TFSA, RESP, or DSPs. The first home savings account is not offered in those platforms, but those are self-explanatory. TFSA is non-taxable and will be never taxed. So that's another option too that these funds can offer. Because traditionally, private equity, private capital was always for non-registered assets for the most part. These funds have taken the time to create an offering memorandum and a structure where registered accounts can be used to shelter money or defer taxes at the end of the day. Next slide, Sarah. So we're looking at over a 15-year period from the previous numbers, from the previous slide, that the outcome interest-only strategy versus a structured strategy, the outcome over a 15-year period, and really the difference here is the compounding effect and the tax sheltering of growth. You can see there's a big difference for your retirement. And also, if you want to generate income during retirement, these are great options too to help you manage the tax burden. And we wanted to thank everybody for your time tonight. We appreciate your patience, and hopefully it's been very helpful. And any questions that you might have, I know Sarah will be reaching out to you just to follow up to see if anybody has an interest to look at these investments and these options a little bit more in depth, and to speak to a dealing representative like myself or Michael Latrue to help you guide you through the choices and the options. And does this not make sense for you from the point of view of investments? I wanted to thank Jamie and Darren again. Thank you so much, guys, for your time tonight. Really appreciate it. And everybody have a great evening. Everybody stay safe, and we'll see you soon. Take care.
Thank you.